Hello. This time we're going to talk about something very, very fundamental to accounting, very important foundation building. It's going to be useful to financial accounting. It's going to be useful for managerial accounting. It's going to be useful to understanding other subjects as well. Many people, when they study accounting, no matter which accounting course, what the level it is, many people are confused because, for example, let's talk about inventory. And we know production, which our cost account managerial accounting talks about, is particularly related to production process and to results of production, different kind of inventory, WIP, raw material, finished goods. So many students are wondering, hey, how do we keep track of this? Because every week, every month, every year, you have beginning balance of different inventory components. And during the year, during the period, you are buying more, you are making more, and you are consuming, selling some. And if there's any balance, it's difficult to keep track of it because while raw material, WIP, and finished goods, we refer to the tangible products, things we can actually touch and feel, we also have to add direct labor and overhead, which are intangible and they are consumed. And they will change different inventory components balances for sure. So how do we keep track of it? On top of that, inventory, like we said, generally have three components: raw material, WIP, and finished goods. And sometimes there are new things coming in of these different categories. Sometimes they are consumed. And how do we keep track of these as well? Well, it's not too difficult if you think through everything. And hopefully this video can help you go over all these. First, let's talk about general accounting process in a time sequence. If you learned financial accounting before, for financial accounting, we have balance sheets and income statement. While balance sheets talk about assets and the liabilities and the equity at a certain point of time, for example, end of 2018, end of 2017. And the income statement talks about operating activities, which hits income statement during the period, for example, fiscal year 2018, which is between the time point of end of 2017 and 2018. Well, this seems to be complicated, but if you really see through it, we can easily understand. For example, at a certain point of time, we see what the company had. When I say had, I'm referring to the assets, liabilities, and equities. So at a certain point of time, we knew what a company had by the point of time. And then after some periods of operating and other kind of activities, while might include financing activities, includes investing activities, after this operating period, by the period ends, the company will have something differently from the previous period end. Then it goes on for another period of operating, running, then we have another period ends, which basically companies through their operation, they will accumulate some stuff, consume stuff, make some money, lose some money, expense something, have some income coming in. So those will change what a company had, what a company owed, and the equity of the company as well. So this thing goes on and on. This is true for not only for the general accounting process, but also applies to different accounts as well. For example, inventory is the same, and inventory, we call it some results of production, or we can also relate to our daily life, our bank accounts. Probably today we don't have too much in our bank, but if we think about it, at a certain point of time, for example, certain months, at the beginning of the month, we have some money in our bank account. Then you will do something during the month. For example, you buy some video games, and you buy nice food, you went to restaurants, you bought yourself some laptop. So that's the way for some activities you had which consumed money. Money will be used from these activities. On the other hand, you were still working, so you have employer's paycheck deposited to you. And you might be selling some of your stuff on eBay, on Amazon, make some own money, or you have some money you invest in stock market, which you were lucky enough to make some money as well, so you have money coming in. So by the period end, by the month end, from your beginning cash, you add how much you made, you subtract how much you used, that's your ending balance. Or we view it from another perspective. If you compare your month end bank account balance to the beginning of the month bank account balance, and you have less cash, less money, what does that mean? Means that you used more than you made. probably it's not a good thing. And you have more than you had at the beginning of the period, meaning that you made some more money than you spent, which is a good thing. So inventory account is no difference. As long as we figure out what will make certain accounts higher and what activity will make certain accounts lower and what these are, and what are the period we talk about, for example, maybe 1 week, maybe 1 day, maybe 1 month, might be a quarter or a year or 10 years, then we should be good to go, but it requires some thinking. So again, to begin our story, we talk about inventory. So at the beginning of the period, we have beginning balance of inventory, and inventory has 3 components. Some companies might not have raw material at all. If they are, for example, like Costco, they don't make anything. So they won't have any raw material, they won't have any WIP, they just have finished goods. And some companies, manufacturers, like Dell, whatever stuff, they might have raw materials, WIP, and finished goods. So at the beginning of the period, at the moment, if you look at a certain company, all the companies that has inventory, their inventory should be no more than these 3 categories: WIP, raw material, and finished goods. And the total of raw material and WIP and finished goods should equal to the beginning balance inventory. And at the period end, it's going to be the same story. After certain months, at the year end, you look at the end inventory, you figure out how much the inventory is worth, but the inventory is going to be consists of the 3 components or fewer: raw material, WIP, finished goods. In accounting, one concept is important, which is a time point, which is why I put a beginning and ending on both on the sides to indicate at what time points we are talking about. So we know companies will engage in certain activities which will change the inventory balance. If ending balance and the beginning balance, they are different, and then we know there are some, or even the same, there might be some activities. But if we know, for example, any inventory is higher than beginning inventory, we know overall from 3 categories, if we have an overall look, we know the company must have bought more inventory than consumed. On the other hand, if any inventory is less than the beginning inventory, meaning that a company consumed more than they bought, which might be a good thing. However, inventory has 3 categories at the most. And we can do the same thing for each category. And as long as we figure out, we apply the same bone to each category, but they will have different meat because they're different accounts. So for each category, namely raw material, WIP, finished goods, all we have to figure out is at the beginning of the period how much they had and what made this inventory account have more balance, and which activities reduce the balance of this particular inventory account for the period, and then we do all the calculation, we will have the ending balance. So let's take a look. What is raw material? Raw material is the assets company has to make stuff, the tangible assets. They are not in any shape of completion compared to finished goods yet. They are just scratched there. Nobody has worked on these. So if we think about it, how can raw materials balance? How can the company have more material balances? The only way is to buy more usually. So when companies purchase raw material, the raw material balance will be higher. Then, how does raw material balances go lower? So normally speaking, in real world, raw materials might be stolen, might be damaged due to disaster or improper safeguarding or keeping. However, in the ideal world, in our book, which is in the introductory accounting course, we'll make it simpler. So how can raw material balances be lower? How are raw materials consumed? When companies starting projects starts to use the raw material to make, the moment they start using those raw materials to make WIP, which essentially is going to be converted to finished goods, raw material is used, they are no longer raw material anymore, they become part of the working process, WIP. So this is a moment raw material balance is reduced. So we see that on top of the arrow, the green one, we have how raw material balance increased for the period. And Below the arrow, we see raw materials are consumed, which will reduce raw material balance, and which will give us ending raw material balance. And then we talk about WIP. What is WIP? Working process. And what is working process? It's a very, very broad area we are covering, referring to the different production stage, right? If we talk about the inventory, when we talk about raw material, we know nothing has been applied to this yet. So it's 0% down. If we talk about the finished goods, from the whole product perspective, finished goods is 100% down. So anything between 0% down and 100% down, we call them WIP, working process. You might just start for 1 second, then the raw material is no longer material, becomes part of the working process already. You might be 1 second from completion, but as long as you have not completed it yet, then you are 99.99% complete. That's not a finished good. That is still WIP, working process. So pay attention to this. WIP is a very broad concept. How do we make WIP? We use a Lego case, right? We use a Lego case. For me to build the Lego sets, if we recall this, the pieces are my raw material. Then when I start, as long as I put my first 2 pieces together, those pieces become WIP instead of raw material. Then I have my labor cost. I have to work on this. I have my labor cost, and I lease the place for this. I turn on the lights for this. So these direct labor and the overhead all become part of the WIP cost, which should let WIP become higher and higher, higher than the raw material itself, because you have to take into consideration the labor and the overhead. So new WIP started, and additional, over the process, of course, additional raw material will be used, right? Because you can put from 2 pieces, you may put 1,000, 10,000 pieces all together, depending on what you might do. So this is how WIP gets more and more. And then when WIP balance gets lower, if you think about it, what's the difference between finished goods and WIP? WIP is not ready to sell. Finished goods are ready for sale. So how companies will never sell WIP under normal circumstances, right? So how WIP balance becomes lower? At the moment when the WIP is completed, when the inventory is complete, when the finished goods is complete, on that moment, it's no longer WIP, it's finished goods. So in our context, WIP balance is reduced when it's completed into finished goods. So we have this transaction again. And then we have finished goods. What is finished goods? Finished goods are stuff that is already made, right? So how do we make finished goods? Unless it's like a Costco, unless it's a retail, whatever stuff for manufacturing companies, finished goods, because they don't buy finished goods, they make finished goods. As long as WIP are finished completely into finished goods balance gets higher. And so finished goods is there. What company make finished goods for? For sale, right? When they sell to other people, finished goods becomes other people's assets. It's no longer company's assets. Of course, it's going to be reduced from the finished goods sub-account. So when inventory is sold, cost of goods sold, finished goods account will get lower. We can also take a look at the red arrows here. Raw material consumed will be how raw material is consumed. We said because it's consumed to convert the raw material from raw to WIP, so they can eventually be finished making to finished goods, right? So in the raw material process, the raw material in the WIP process, the more the raw material consumed actually kicks into the WIP account. Of course, then you have to plus additional you have to plus labor and the overhead. And again, if we look at the second arrow, WIP completed. How many WIP completed subtracted from WIP account because you have completed into finished goods will be how much finished goods were added to the finished goods account. So we have to see the correlation. When we look at this, each account is correlated directly or indirectly, and we have to pay attention to this. We have to take our initiative to think about these correlations, associations. Now let's present everything in a more straightforward, more like an equation type of manner. Again, to begin this, we said your beginning bank account deposits plus how much money you made subtract how much money you used for the month equals to your end of the month bank account money. We understand, right? So for raw material, it's nothing different. Your beginning raw material balance plus how much raw material purchased, subtract how much raw material consumed for what? To make WIP. It's going to be your ending raw material balance. And then for beginning WIP, you have to plus how much new material, new WIP cost added, right? Some WIP might be from scrap 0 to 50%. Some WIP might be from 1% to 99%, as long as they're not finished yet. All those things with labor, material, whatever stuff, they'll be part of the new WIP costs, as long as they still stay in WIP account. That's how much WIP balances were added. And then when WIP is reduced, when it's finished, so you have to subtract WIP completed during the period into finished goods, which will give you ending WIP. And for finished goods, it's going to be easier because when you have more finished goods, when the WIP is completed for the period, you have beginning finished goods, and then you have the finished goods finished during the period, which will make your finished goods account higher. And then when you sell, the finished goods will be removed from your warehouse, which will make your finished goods account lower. So by the period end, you have beginning, you have how much you had during the period, you have how much you sold during the period, and which can give you ending balance, how much they left you with by the period ends. So if a company made more than they sell, if a company made more than they sold, of course, the ending finished goods will be higher than beginning finished goods. If a company sells more than they make, sold more than they made, then the ending balance will be lower than the beginning balance. Can we see the correlations? And let's apply these thinkings to the later chapters and the beginning chapters. Let's think about even we can apply those to the financial accounting classes we have learned. I'm sure it's going to be useful, but keep this in mind, take a look and really understand it instead of just see different color shapes.